Hey guys, how's it going? Lewis Harding Investor and welcome back to my channel. And in today's video, I'm going to be going through 3 UK stocks to buy in a market crash. Let's get straight into it. So the first company on my list is Diageo. Diageo plc is a British multinational beverage alcohol company with its headquarters in London, England. It operates in more than 180 countries and more than 140 sites around the world. It was the world's largest distiller, but it was overtaken by a Chinese company in 2017. It is a major distributor of spirits and the world's largest producer of Scotch whisky. Diageo has a primary listing on the London Stock Exchange and it is a constituent of the FTSE 100 index. So firstly, we'll have a look at the genuine impact stats for Diageo, and the two main I look at are the quality and value metrics. So let's start with quality, and it does rank pretty high on the quality metrics. Profitability is very high, which is one reason I was attracted to this company in the first place. The financial strength is showing pretty weak. They do have a decent amount of debt on the balance sheets. You do find this with consumer goods companies. Companies like Unilever also have quite a lot of debt, so it's quite a common factor with these guys. You just want to make sure it's manageable, really. And sound capital allocation. I do believe they pay a decent dividend, and I don't know if to buy back shares. We'll see in my analysis after this. Value metrics, it's looking quite expensive in all metrics, really, especially on the balance sheet. So not really too good from the value metrics. It's a little bit pricey, it does seem. But yeah, then let's have a look at the growth metrics in the bottom left hand corner. And yeah, they're showing fairly decent, modest revenue growth, decent earnings per share growth, and yeah, dividends increasing over time alongside free cash flow to equity. So yeah, interesting stuff from Genuine Impact. So now onto my analysis checklist for Diageo, and Diageo is listed in London on the London Stock Exchange and it has a market of 118 billion, that is dollars. I've got it up on Google as well, so it's 87 billion pounds. So a fairly big company, to be fair, one of the biggest on the FTSE 100. It's got a current share price of £37, and yeah, a PE of 33. Wow. And yeah, anyway, let's have a look at my actual analysis. So let's have a look at the profitability side of things and the debt. So yeah, very, very strong on the profitability. So yeah, high gross margins, high net margins, way above what I'd like to see in a company. And then yeah, very strong return on equity as well. The long-term debt to equity is a little bit of a concern over the 50% mark, but if this is manageable, but it's not too bad. But yeah, current ratio way above 1, so really, really good stuff. Proven ability to grow, so yeah, the revenue and net income has grown over the past 5 years. Shareholder equity is down, something you have to look into when doing further analysis. And free cash flow is up, which is really, really good to see. Great capital allocation, so yeah, over the past 5 years we have issued a fair bit of debt. So whether this is due to acquisitions or whether it's due to just normal operating needs, it's something which needs to be understood because you want your debt to be going down over time. Dividends going up over time, shares decreasing, and then yeah, acquisitions wise, I'd say they probably are doing good acquisitions because they are consolidating a lot of the alcohol brands, like a lot of the other alcohol, companies in the world are. We're all consolidating at the minute, but you have to look into that a little bit more. I don't know too much about Diageo. All I really know is they're big on spirits and the on Guinness. So yeah, buy at a fair price. This is a clear fail, of course, and the PE ratio of 33. Very, very steep for a company which isn't going to grow much into the future, and the price of free cash flow is fairly similar as well. Earnings and free cash flow often, well, over time they should be very similar amounts, and this is showing a very, very similar figure. And yeah, for a 10% return, I'm looking at a share price of £16, so it would take a bit of an ugly drop for me to be interested in Diageo. Let's have a look at my DCF calculation to see how I got to that figure of £16 per share. Now let's have a look at the discounted free cash flow valuation for Diageo, and I've taken my free cash flow estimates from Market Screener, from analyst estimates, and yeah, they look fairly reasonable, to be fair. It's slowly going up, nice and steady way, which you would probably expect for this business. But yeah, anyway, my discount rate is 10%, and yeah, it spits out a share price of £16. So yeah, from current levels, it needs to drop over half. So yeah, this company is definitely on my watch list. It is a bit of a beast, but yeah, I don't think a company of this size It's not even a size problem really, it's more of a growth thing. So a company which isn't going to grow much doesn't deserve a PE of 33, and that's simple math. So yeah, let's move on to the next one. So the next company on my list is Games Workshop. So Games Workshop Group PLC is a British manufacturer of miniature war games, and it's based in Nottingham. So its best known products are Warhammer. So it was founded in 1975, and it was originally a manufacturer of wooden boards for games, including like Backgammon, Nine Men's Morris and Go. I don't really know them games. But then, yeah, it became an importer of the US role-playing game Dungeons & Dragons, which is a popular game worldwide. And yeah, so it started promoting games such as Lord of the Rings in 2001. And yeah, it's also listed on the London Stock Exchange and is a constituent of the FTSE 250 index. So now onto the genuine impact stats for Games Workshop, and having a look at the quality and value metrics. The number one which stands out here is for quality. 273 it ranks on the universe of stocks. That is very, very impressive, I must say. Looking deeper into the quality metrics, and the profitability is extremely high. 101. Wow, that is amazing. And yeah, I have been impressed by this company from what I've seen, for sure. Strong financial strength. There's no debt on the balance sheet, which is impeccable really for companies nowadays, and capital allocation is looking good as well. From a value point, it's maybe a little bit expensive potentially, which is shown from the income statement and balance sheet side of things. The cash flow is shown from a medium side, and we'll have a look at the cash flow later. But then yeah, let's have a look from the growth side, because another very important factor in it is ranking really, really high. All very high apart from the free cash flow to equity, but yeah, overall very, very impressive stuff. Now let's have a look at my analysis checklist for Games Workshop, and it is listed on the London Stock Exchange. It's got a market of £3.2 billion, and yeah, the current share price is £96.55. Yeah, the PE is 26 and it's got an earnings yield of nearly 4%. Let's have a look at the metrics then. Yeah, green across the board. So gross profit and net margins are extremely strong. Them net margins especially, they're very, very impressive. Return on equity is unreal as well. There's no wonder this stock is one of the favourites in the city, and it's been one of the past favourites over the past 10 years, I believe. Yeah, there's not much debt, and yeah, the current ratio is way above 1. And I must say that long-term debt to equity ratio isn't actually the long-term debt, that is all of the debt, because I couldn't find a long-term debt to equity. I could only find the debt to equity, and yeah, very impressive stuff. Proven ability to grow, yeah, over the past 5 years, everything has grown. Very rare to see. I think it just shows how good of a business Games Workshop actually are. And then yeah, great capital allocation. If you haven't paid any long-term debt because you haven't had any, dividends have grown. They've also paid, bought shares back, and it looks like they've made some decent little acquisitions along the way as well. So yeah, a very solid, decent little business. But then this is where it turns a little bit red, unfortunately. Buy at a fair price. So unfortunately, I think the company is a little bit overvalued, not by too much. With a PE ratio of 26 and a price to free cash flow ratio of 31. It's maybe a tad steep, but it's not too far off really. I think the share price for this company has risen a lot, since the start of the pandemic. And I believe after the pandemic hit, it was at a share price of £40. So it's not actually far away from where it was like a year and a bit ago. So it's not beyond the realms of possibility that it could get back down to that. But anyway, yeah, for a 10% return, I'm looking at a share price of £69, and it would have to drop 28% from the current share price. But let's have a look at the DCF valuation to see how I got to that figure of £69. Right, so onto the DCF valuation for Games Workshop, and I've taken my free cash flow estimates from our market screener once again, and yeah, for a 10% return, we're looking at a share price of £69. You'll see on here that I have adjusted for the net cash balance. That's because there's no debt at all on the balance sheet, and there's just a big lump of cash sitting there. And I believe it does make sense to add that onto the market cap when you are evaluating a business. I wouldn't usually do this for companies unless they had a net cash surplus, but Games Workshop is a very, very unique business, a bit similar to like Google and Facebook, where they have no debt, and adding cash on to your valuation at the end makes total sense, because there's no debts to pay at all, which is bonkers. But yeah, £69, not too far away really. 28% drop, that happens all the time in the stock market. So if you think Games Workshop is a good business, then get it on your watch list. It might be one to look out for in a market downturn. I'll be adding it for sure. I'm going to do a bit more research into the business and understand Warhammer and all these games, but the business is impeccable for sure. You can't deny it. So the third and final company on my list today is Wise. So Wise PLC, formerly known as TransferWise, is a London-based fintech company founded by two Estonian businessmen. So what Wise do is they are an international money transfer company. So they make transferring money across borders really, really simple and really, really cheap, basically. A fun stat here, which is on Wikipedia, but I've not clipped it for this YouTube video, is in 2017, British bank Santander claimed the bank would lose 84% of its revenue for a money transfer business if its charges were the same as Wise. So basically, Wise have thrown a massive spanner in the works for all the major banks in the world, and they are making international money transfer basically, very reasonable for general public. So they are a big, disruptive business for sure. They've not been around that long. I think they were founded in 2011, they IPO'd in 2021. One of the biggest IPOs of the year, I think, for London Stock Exchange. Now onto the genuine impact stats for Wise, and the quality metric is showing a score of 22, which that's pretty crazy, to be fair, to be the 22nd ranked on genuine impact. I think it might have something to do with the profitability, one being nil. They are a profitable company, so I'm not sure how that's working out. But anyway, the financial strength and capital allocation are showing very, very strong, which is obviously fantastic. But then from a value perspective, it's looking a little bit expensive from current levels, with the income statement and balance sheet looking on the expensive side, but when the cash flow side is looking cheap. So interesting way to weigh it up. Then on the growth metrics, the revenue is obviously very good. They're growing revenue at a rapid rate. Now let's have a look at my analysis checklist for Wise PLC, and the market cap of this company is £8 billion. The current share price is £8.32. They've got a P ratio of 375. Wow, that is very high. And you may be thinking, why is this company on your list, Lewis? Well, you will see very soon. So onto the metrics itself, and I've taken this lot from Morningstar because Macrotrends doesn't have the data for many UK companies, only the biggest ones which have ADRs listed in America. It was the same for Games Workshop as well, by the way. That data all came from Morningstar. I'll probably start using them for UK companies going forward. But anyway, away from that tangent, gross margins are fantastic for this business, extremely, extremely high, really, really good stuff. The net profit margin, they've started getting more and more profitable. The margin's a little bit low at the minute, but you would expect them to go up over time as the business matures and evolves. And that's something you want to see going into the future. Because of this, return on equity is a little bit poor as well, but over time you want that to be going up. But what's really good about this company is there's not much debt going on at all. Current ratio on long-term debt to equity, very, very good. And I must say, similar to Games Workshop as before, that is the total debt to equity. So being prudent and putting that in there, it just shows that there's not really that much debt in this business, which is awesome. Proven ability to grow, revenue growth, net income growth across the board, and shareholder equity growth and free cash flow growth. Fantastic, really. Great capital allocation. So I don't think they've really had much chance to show great capital allocation yet, being such a young business. And this is something, as we become more profitable and more free cash flow comes through, you want to see them doing more of these four things. So long-term debt repayment, they took out a bit of debt a few years ago. I wouldn't be too fussed about this because it's not much compared to their equity. There's no dividend growth because there's no dividend yet, because they're busy growing their business. Decreasing shares, I couldn't really find much data on this, but I'm sure will have been increasing with it being a young company, but I had to put 0 because I couldn't really find the data. I didn't want to troll through the company accounts. Good acquisitions, I can't really see any, so we had to score as an X for that. But then buy at a fair price. Unfortunately, it's looking a bit expensive, which you do often see with IPOs, especially with this company being probably one of the it's definitely one of the hottest IPOs in the UK for a while. Wise, Deliveroo, Dark Trace, all of them lot, the Hut Group, they're all major IPOs over the past few years, and this has been, one of them. So my DCF valuation is showing for a 10% return a share price of £1.10. So yeah, that would take an 87% drop to get to that fair value. So you might think, Lewis, but it's never going to drop 87%. Well, let me tell you that weirder things have happened in the stock market, and if a major correction came, who knows what could happen. But yeah, it would have to drop 87% for me to be interested. But yeah, let's have a look at the figures and see how we got to that figure of 110. So now onto the DCF valuation for Wise, and I've taken my free cash flow estimates from Market Screener once again, and my discount rate was 10%, so that's the return I would like. And yeah, it spits out a share price of £1.10, so yeah, quite a way off from the current share price, unfortunately. You could probably do this model out, you know, a lot further than 3 years, and I probably think I'm being very prudent by only doing it by 3 years of his business, because the free cash flow is probably going to be a lot higher in 25, 26, 27, all the way to 2030. But I'm a prudent investor. This is what I'd like to do. You know, if you want to do it, you can download the spreadsheet yourself and have a play with the figures. But yeah, for me to buy this company, it would have to drop quite a lot. But yeah, very promising company itself, coming into profitability, and I'm sure that's just going to improve over time. So there we have it. There were my 3 UK stocks to buy in a market crash. Let's go through them again. So it was Diageo, Games Workshop and Wise. If you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.